All right, we're ready to move on to a new chapter because you've got this last chapter completely nailed down, feeling completely comfortable about it. So ready to move on, right? You're like a little better in this class than in accounting one. Like there's a little more breathing room, I feel like. I don't know if that's true. What do you guys feel like? It is. It's less
punch my screen.
less less punch your screen in rage. Well, I gave like 6. Maybe I'm being a softie. I need to change that. Oh, okay. So chapter 24, this is about evaluating decentralized organizations. I think right now, something that's maybe an interesting way of thinking about centralized organizations and decentralized organizations. I don't know if you guys know, prior to my working here at EAC, I was a stockbroker for Edward Jones. And then prior to that, I was in the military. And we're seeing an interesting case study right now in centralized versus decentralized operations in the Russia-Ukraine conflict. So the Russians have very centralized operations, meaning battlefield commanders, sergeants and lieutenants on the battlefield are not allowed to make decisions without the go-ahead of a general, okay? So they have battlefield generals and they can't make decisions without them. US forces are battlefield leaders. They can make independent decisions. So in essence, they're given a broad sort of mission or command by the generals, and then the squadron or brigade commanders are going to give orders to their smaller units like platoons or flights in the Air Force. And then they're going to trust their people to sort of use independent thinking when they're out there in the battlefield to adjust to battlefield situations. And so the Ukrainians have killed so far in this conflict 5 Russian generals. And that has really impacted Russia's command and control. If you're not allowed to make a decision without a general and your general just got shot, there's this whole like struggle to be like, who's in command now, and then how do we adjust to it? Whereas in a decentralized situation, you'll kind of be able to just pick up and keep going even if the leader gets killed. So it's been an interesting thing to watch from a I was trained in and brought up in a fairly decentralized military. Don't get me wrong, it's still the military and there's still like a boss, a commander, and you follow the commander. But I was expected at all times to make decisions on the fly, even as a young sergeant, a 22-year-old sergeant. I had 17 people working under me, and we had a mission to complete. And so long as I successfully completed the mission, nobody's going to get too mad at me typically. Now, if you do go off of what the leaders say and then you don't successfully complete it, you're probably going to get in trouble, right? So it's an interesting thing. I was thinking about this from a business standpoint. You've probably worked for businesses that have very centralized operations, a very hierarchical structure, and you can't do anything without the mothership's approval, okay? And you probably also maybe worked in places where it's a little more like we allow people at each of the regional locations to make some decisions to go with their market. So this is how they have it sort of drawn out on here. Again, nice picture. Centralized organizations, top management make all the major decisions. Whereas in decentralized, we allow division managers. And then most businesses are like not truly decentralized, right? Like here at the college, I can make some decisions as a division head, but I can't. We want to make sure that I'm not making decisions trying to run my organization that are going to run contrary to the whole organization's needs, right? And so that's actually, some of the advantages of decentralization are, you can see them on the board there. I won't read them all to you, but this allows managers to become experts, and it improves creativity, and it usually improves customer relations too, right? So if I'm able to sort of meet the need of the customer now without having to go call headquarters, that usually improves our relationship with customers. The downside to that is sometimes in an effort to make things better for the customer, in the case of like this division, for the students, or maybe I want to make things better for the faculty who work here, I might make decisions that are not helpful to the whole organization, right? So we have to be careful when we decentralize that we still have enough control centrally to balance that out. The other big issue with decentralization is now, and we have this a bit going on at the college, every division feels like they're their own unit. So everybody thinks they need a copy machine, right? And copy machines are $20,000 a piece. So instead of having, say, one on North Campus and we all go over there and make our copies, we think we have to have one in each building. That can really increase prices as we duplicate assets and sometimes duplicate expenses across these decentralized units. Okay, so there's a downside. So yeah, so yes, in that I was running my own office and had my own people, but no, in the sense that I couldn't make major changes that would deviate, just because of mostly compliance rules. You have to follow certain legal rules when you're selling stock, and so it was decentralized in some senses, but right, but because of government regulation, there had to be quite a few rules overarching everything. Yeah, yeah, yeah. No, you're never going to be fully I mean, maybe you'll find some business model that is fully decentralized where people can make all decisions, but you think about it, that doesn't really work. You've got to have some overarching command and control, right? And likewise, something that's too rigid of a structure doesn't allow us to be flexible to meet the needs of customers. Maybe. So again, so this is an accounting course, so we're trying to consider this decentralization or centralization from an accounting standpoint, right? How do we account for these things? So what we do is we do something, they call it responsibility accounting, and the idea is that from a managerial standpoint, we kind of only hold people responsible for the things that they can actually control. Okay. I will tell you, it's frustrating as a manager when someone's asking you why you why your revenues aren't better, and you're like, because I don't have any control over revenues. Consider the college again. How much control do I really have over revenue in this area? I mean, indirectly, right? We can get more students, and more students generate more revenue. But then when you pay your tuition, or when the state pays aid to the school based on student enrollment, even if you're a business major, a certain number of your courses are gen ed, so they're even outside of my area. So it's really hard to do that well. So for responsibility accounting, we look at we break responsibility centers down into three types. The first are called cost centers, meaning they are a unit of the business that really only has control over costs. They don't have control over revenues or over the assets of the business. So the most a manager in a cost center can do is try to control costs, keep costs low or appropriate. Okay. The second is what's called a profit center. Profit centers have responsibility over revenues and costs. Finally, investment centers, they have responsibility over revenues, costs, and investment in assets. And so the idea is we want to set goals and measure performance based on what each unit of the business, whether it's a division like we call them here at the college, or a department, or a field location, or whatever we call it, right? Or in the case of like retail, each store becomes its own profit center usually. So think of Walmart. The store manager at Walmart, they don't really have much control over assets. The main company in Bentonville, Arkansas, is going to decide if they're building a new building or if they're doing something massive like that. So instead, they just have control over revenues and costs, the store manager. And so we would call each store in Walmart a profit center. And then probably within the store, there's departments, and they probably have limited control over their revenues. I mean, they could try some things maybe to sell more of their stuff, but mostly they're a cost center. So that department manager is just making sure we're not having too many people working, you know, that we have an appropriate number of people to work to cover the shifts and so forth. Okay, that's the idea. All right, so a cost center manager has responsibility for controlling costs, but doesn't make decisions concerning sales or the amount of fixed assets invested in the center. So here's the example they give out of the book. We have a university. Universities are broken down into colleges, and then colleges are broken down into departments. Here at AAC, we have the college is broken down into divisions, and then divisions are broken down into departments, okay? And our departments are actually broken down, I've told you this before, just by the prefix on the course. So if a course has a BUA prefix, those belong to the business administration department. If they have a BUS, they belong to the business department, SBM, small business management, etc. We've actually just combined AIS, SBM, and BUS into a single department in the last year. And that doesn't sound like anything major, but everybody was like, oh, innovative, right? To me, it was like, why don't we just consider all associative applied science-based programs as one department and all transfer programs within our division as a separate department, because they all have the same goals outside of that. All right. So this is a little hard to see. It's kind of tiny, but for cost center reporting, all it's really going to have on it. So here, this is the budget performance report for the supervisor of Department 1, Plant A. It's just going to have, this is factory wages, materials, supervisor salaries, etc. So it just has the costs. And it just has the actual, the budget, and whether they're over or under budget. That's it. It's not an income statement because they don't have control of revenues. And so if you think about it, if you're the manager, it's kind of nice to like just be held accountable for the things you can control. Even on that list, there's probably things the manager feels frustrated about because they can't really control it, right? For example, here at my division, I can't really control the salaries of all the people that work here. Why? Well, because we have a college-wide policy with a salary schedule in it that says, if you have this level of education and this many years experience, this is what you get paid. And so the only way I can control that is to say, recently we had, I don't know if any of you ever had Mr. Watson. He retired from here, Greg Watson. And so I was able to say, I don't think we need to replace Mr. Watson. I think we can cover his classes, and maybe we'll hire a part-timer to cover one of them, and then the rest can be spread out. So that was a way I was able to control that cost, right? I can make that decision. So that's a cost center. So profit center just means now that, again, the manager has control over revenues coming in and expenses, which means they can make decisions that will affect those things. That's what we mean when we say they have control of those things. So typically a profit center's responsibility accounting is going to look like an income statement. It's going to have revenues and costs, or revenues and expenses. Often we try to break things down into just focusing on the controllable revenues and the controllable expenses. Again, there are some things we can't really change, and there's other things that we can. So here at EAC, we make revenue, 1, by student tuition, 2, by something called full-time student enrollment, FTSE, or sometimes people just call it FTSE. And that is the state of Arizona pays a fee to the college based on the number of full-time student equivalents, okay? So for example, this is a 3-credit class. 15 units or 15 credits is considered full-time. So 3, 6, 9, 12, 15. You guys are a full-time student equivalent right there. 15 credits. So 1, 2, 3, 4, 5. So we have 2 FTSE sitting in this class right now. Or as some administrators like to call it, seats in butts, or butts and seats. That's what they call it. How many students do you actually have attending your classes? So even though it sounds like we're people, we should be considered as people, from an accounting standpoint, we also have to consider you revenue sources, right? And that sounds kind of horrible, but that's business, right? Like, we have to recognize, so what can we control in that? Well, really not much, because the state pays a fixed amount per student or per full-time student equivalent. And so all I can really control is the number of students. And so recruiting or marketing students into my classes is about as much control as I have over that revenue driver. Expenses, again, I told you more than, so my department budget, it's my regular annual budget, more than 70% of it is faculty salary. And I don't have control over that. So I can make sure we use fewer supplies, or that we don't travel as much any more than we have to, that we turn out the lights when we leave. And even that, they don't charge that directly to me. They do it as an overhead. And so I have really limited control. So even though I have revenues and expenses, they're not all controllable revenues and controllable expenses. In the end, I can only control the things I can. And so a fair report on me would be something like just the expenses I can control. Unfortunately, here at EAC, they haven't evolved to that yet. And so what they judge us by is they look at the department, the prefix, they look at the number of students taking it, and then they do the total cost. And so we get this number that is our cost per student credit hour. And it's not something, A, it's hard to control the number of students you have, and B, it's hard to control most of the costs. And so when they then at the end of the year, they say, please explain why your cost per student credit hour is in the 53rd percentile, right? We have to do these little reports, right? And you're like, because that's where it is, because I can't control it. No, it's an interesting thing. So we just got a new controller here at the college this last year, and he came out of industry. He was working for Freeport as an accountant up there, and he's trying to bring a lot of these ideas in here. And for most of the academic, if you think about who the leaders of a college are, they're people who were English teachers and science teachers, and they've moved up, right? And so for a lot of them, they're just like, whoa, I don't know, I don't really understand this very well. And so so we kind of rely on him. I'm hoping we'll have a better measure. The idea in the end, right, is that we would keep the strongest programs, and we would try to bolster the ones that are weaker, so that the college is making sufficient money to cover those programs that can't. All right. So just like we've learned before, what do we do when we have service departments that really don't generate any revenue at all? And how do we take their costs and how do we spread them out? And it's the same thing we've always learned, which is these outside service departments are going to end up being their costs or expenses are going to be allocated across the profit centers, right? And whatever cost driver they want to link to it, right? It's the same thing. So this isn't new. What is the college president earns a salary? Well, how much of that should go to the business division, right? So again, same way, we just have to come up with some scheme, and whether we use student enrollment or something like that, we spread those things out. So same idea. Who pays for the cost of this beautiful green grass we have here, right? Which department? Our choices are either to allocate it to all the departments that generate revenue, or to try to do this decentralized, like a variable costing scenario, where we pull those off to the side and say those are just overhead to the whole organization. So this isn't anything new, just explaining the same idea. So profit centers may have expenses that are incurred by service departments that are getting added to their expenses. And as you can imagine, if we're doing this responsibility accounting, and as a manager of a profit center, I'm being allocated costs from outside service departments, or not outside, they're internal, they're part of the organization, but from outside of my department. And there's always going to be angst and pushback about how those things are allocated, especially if the department manager's bonus is tied to how profitable they are, which is usually how they do it. So for most companies like Walmart, for example, a Walmart store manager gets a base salary of about $65,000 a year, but most of them make around $120,000 a year. And that extra 55,000 is based on profitability bonuses. And so if I'm controlling all the costs I can control in my store and maximizing all the revenue I can in my store, and then you are putting, in a way that feels arbitrary to me, other shared expenses or allocated expenses onto me, and that lowers my profit, which lowers my bonus, I'm going to be frustrated by that, right? So as you guys move forward, I mean, remember why you're in business school is because you're going to be going to work in business. As you move forward, try to consider these things, right? Try to consider your remuneration processes in such a way that they really get people to do what you're trying to get them to do. I don't think you have to put allocated costs on because an allocated cost is usually not controllable to the manager. So you can have that standalone. Let's see. Service department charges are indirect expenses to a profit center, and the profit center manager has control over service department expenses if the manager is free to choose how much of the service is used. So something like the president's salary, I'm not free to choose that at all. But if it's something like maintenance on the building, and I can choose, we want some maintenance to happen, but some maintenance we can wait until the next period or something like that, then that's a little more controllable, right? The way it's done here at EAC, I have zero control. Pretty much if there's an issue in the building, I submit a work order and they fix it when they can. I can't say like, I guess I could not submit a work order, but we want to keep our buildings nice, right? There's an area where decentralization sometimes causes problems because you'll have a manager say, I want to keep my bonus high. So then they never get the maintenance done, and then the building's falling apart, and that looks bad on the whole college. Okay. So there's, again, the balance of this is challenging. Well, or didn't do, right? So here's an example. This is what a profit center's report's going to look like. Like I said, it looks just like an income statement. It has revenues, and then has operating expenses and support department allocations, and then an operating income of sorts. Okay, so very similar. Just recognize that usually operating, for these type of reports, operating expenses are expenses where we had to buy stuff, services or goods from outside of the company, whereas these support department allocations are kind of like we bought services from within the company. Does that make sense? So for example, when my computer breaks and I have to have computer services come fix it, they come fix it and then they bill us the cost of fixing it, even though no money actually changed hands. Does that make sense? They're providing the service and then billing our department so we can see how much we truly spent in our department, even though, because what we're doing is using a portion of the computer services department's time and resources to fix our computer. So this is operating income before support department allocations. And then we subtract out the support department allocations, and that, yeah. Right. So this is a way when we do a decentralized organization, the idea is if you use the services of these support departments, you're gonna pay for it, even though it's not cash payment, because it's all the same organization. We're kind of like moving money from this department to that. But mostly what we need to do is just track the cost of what you're doing. So this is, if you think about it, it's sort of a way of allocating it would be based on usage, which is probably the best way to allocate if you truly could, right? To say you are purchasing the computer department's time and energy to fix your computers and keep them up and running. Yeah. Right. Right. Correct. So the third type is the investment center, and the only difference between an investment center and a profit center is that investment center managers now have authority also over the fixed assets of the entity. So in my storage business, since it was my business, I was the investment center manager. I was responsible for revenues, I was responsible for expenses, and I was responsible for buying new buildings, buying new land, selling buildings, all of those things. And so we're still going to look at an income statement as part of how we measure or consider how well an investment center manager is doing. But we're also going to look at something called return on investment. So return on investment is just kind of what it sounds like, which is how much of a return, which is a profit or operating income, did we earn for the amount of investments we have. Here's the idea. If you could make $10,000 a year by investing $100,000, and he could make $10,000 a year by investing $50,000, we would say he has a better return on investment. He's, you know, for less investment, he's getting the same amount of money back that you are. And so return on investment is just a measure of how efficiently you're using the assets of a business to generate operating income, okay, or profits. So the main formula for return on investment is operating income divided by invested assets. There's other forms of ROI, which we won't get deeply into in this chapter, but just, so this lets us see, because sometimes businesses will look at like, oh, well, this guy's had 84,000 operating income and they had 70,000 operating income. So the central division is our strongest division, right? And you think that it wouldn't be that way, but even now, even when you have managers and owners of businesses who totally understand business, you just see the bottom line, you see the amount of money. But if you do return on investment, then you'll realize, well, the northern division's actually doing better, because even though they only brought in 70,000, they only had assets of 350,000 to do that with. Because then that question should be, well, if we invested in more assets in the northern division, could they continue that 20% rate return on investment? Because then that would be a good thing to do. Now, it is possible that the bigger you get, the lower that return becomes. That does happen sometimes. But so just recognize that this is one way we help measure how successful a investment center is by using return on investment. So there's two different formulas. The first was just to do operating income divided by invested assets. But another way of looking at it is it's our profit margin times our investment turnover, where profit margin is our operating income divided by sales, and our investment turnover is our sales divided by invested assets. Now, I realize that I'm telling you this and you're like, okay, well, can I just use that? And the answer is yes, but this is meant to give us a conceptual understanding of what return on investment is, okay? So operating income divided by sales, what that means is how efficiently are you converting what you sell into profit, okay? In other words, how well are you controlling expenses, really? That's what profit margin is. And then investment turnover is our sales divided by our invested assets. Or in other words, how well are you using the assets you have to generate sales, okay? Again, that's kind of a measure of efficiency. We all know basic algebra that we can eliminate those two, and it turns out to just be operating income divided by invested assets. But recognize it's a function of our profit margin, how well we're turning sales into profits, and our investment turnover, how well we're turning assets into sales, that decides our return on investment, okay? All right, another measure is something called residual income. Residual income is just our operating income minus some minimum acceptable operating income as a percent of invested assets. That sounds confusing, but in essence, what we're saying is we take our operating income, we subtract what we've set, and then the problems it will have to tell you this is their minimum amount. In order for them to consider this a successful unit, it has to make 20% return on assets, and they had assets of $1 million. So you take $1 million times 20%, 200,000, and then you take operating income minus that, and it gives you what's called residual income. So the idea is this: if we're going to measure how successful you've been as a manager of an investment center, we're going to set some target, right? We're going to say, hey, look, on average, our company makes 12% ROI. And so if you're going to be a successful manager, you're going to at least hit that average. So, and so then we'll say, well, let's see. So your department has $200,000 in assets. And so 12% of that is, what's 12% of 200,000? 24,000, sounds about right. So in order for you to be successful, you're going to have an operating income of at least $24,000. So we'd say operating income, if you made an operating income of 24,000, your minimum acceptable operating income, which would be 12% of your assets, 24,000, we'd say you had a residual income of 0. If you sold more, or if you had made more operating income, then you'd have a positive residual income. And if you made less than that target, then you'd have a negative residual income. So just know that's another tool, another measure we use to measure the success of investment managers. All right. I don't know about the order of this, but if you remember back when we talked about service departments and how we will be billing the services they provide to investment centers, okay, and to profit centers, both. There's 3 different ways, I guess, that people go about doing that. The first is what's called a variable cost per unit, where we just use the variable cost of the services provided for how we transfer, or what I mean by that is provide those services from another unit. So if again, computer services came and fixed our computer, the question is, how do we decide how much they should charge us? Okay. So some businesses say, well, just the variable costs, because the fixed costs are all overhead and we can't really divide those out. So that's one method. The second method is called a full cost. So we're going to try to figure out the full cost, including their fixed costs allocated to it, of them providing that service to me. And then finally is market price, which would be like, if we had to go out and hire an outside computer company to come fix our computers, what would we pay for it? And that's the amount we should transfer those costs across that. So I think the term transfer price sounds confusing. It just means when we have service departments doing work for other departments within a business unit, at what price are we charging those services to the business unit? Okay. And then you see this negotiated price. They have this big red arrow. Well, a negotiated price is just what it sounds like. It could be anywhere between the variable cost per unit all the way up to the market price, whatever we agree upon. So that's an interesting way of doing it. It'd be interesting because it would be like if I had computer services come fix my computers, I might be getting a different price than the math division does because I was able to negotiate a different price. That's the way some businesses do it. The idea is it's part of your management skills to be able to negotiate those things. Again, we don't need, that's just another income statement. So the market price approach, like I said, the transfer price is the price at which the product or service could be sold to outside buyers. Negotiated price, again, that's a lot of confusing language to say. It's just negotiated. We decide how much that transfer price is. Cost price is just, again, based on the cost. And that's it. So, this chapter is some new stuff, but I don't think anything that's like too crazy. Although I said that about the last chapter, didn't I? The last chapter wasn't too crazy. It just had a few moments in the homework where you're like, what do they want from me here? Anyway, so I think it's pretty doable. Friday, we will do a, what's it called? A guided assignment together, and I'll see you then.